Okay, welcome back to the Shared Practices podcast. George, you crushed it with another interview here. Why don't you go ahead and introduce our guest this week?
Thanks, Richard. I'm excited. My content is starting to roll out here slowly but surely, so it's definitely nice to see my stuff out there. When I was showing my practice to Hunter Smith, he recommended Rick Shneyder, a banker in the Midwest, that I contact about my opportunity, and I did. And from talking to Rick, I was extremely impressed, so I decided to bring him on the podcast to discuss conventional loans.
Okay. And we're going to get into, if people are like, well, am I going to qualify for a conventional loan or am I going to have to do something else? We're going to get into that in future episodes of SBA, new grad financing. This is your traditional conventional loan. And the thing that I love the most about this was that Rick Shneyder, I feel like he really gave us the inside scoop on like how the internal politics of a bank play out into whether or not you get a loan and how painful it is for you, this whole process. So he really kind of lifted the lid and let us see some stuff that I've never heard before. So I enjoyed this interview a ton.
Yeah, I was actually a little surprised, during the interview process. I was kind of asking him some questions that I didn't think I was going to get as honest an answer as I did. And, I got to love Rick for that. He's a great guy, and he definitely gave us a great scoop. I did want to add one thing about what you said. This is mainly an episode for those individuals who have been out of school for more than a year. I think that's kind of what I would say.
Absolutely.
And then we're covering under a year and dental students in future episodes.
Awesome. Thank you, George, for doing kind of these interviews, this series of interviews. I think people will get a lot out of this. So we'll head over to the interview.
I have with me here today Rick Shneyder. I'm very excited for this episode. We are going to talk about mainly conventional loans for practice purchases. Rick, why don't you go ahead and introduce yourself to our audience?
Thanks so much for having me. My name is Rick Shneyder. I'm a business banker for Bank of the West, a division of BNP Paribas, and I work out of Milwaukee, Wisconsin. I have been in business banking for approximately 17 years, and my specialty is within the dental lending division. Although I'm still a generalist, I choose to specialize within the dental medical field. I've been specializing in this area for about 11 years and probably done close to 1,000 transactions at different levels, from acquisitions to real estate to partial acquisitions, startups, relocations, refinances, equipment, credit lines, all the above. So hopefully I can help answer any questions, concerns, and help anyone out there that needs my assistance.
Perfect. Thank you, Rick. And I will say that I have talked to probably 40 bankers who do lending for dental offices. And out of all of them, you're the one I selected to have on because you are the one that I want to go with eventually down the road, a year from now when I do my loan. And you were referred to me by Dr. Hunter Smith, who we have had on our podcast for 3, soon to be 4 episodes. And so you're highly regarded, and I'm looking forward to the episode.
Awesome. I'm flattered. Thank you.
And so I really wanted to start with talking about our young doctors, who most of our listeners are either dental students or they're pre-ownership, and they're essentially looking to get financing for either a practice purchase or a startup. Today we're going to talk mainly about the practice purchase. I want you to kind of talk about factors that influence their ability to get or not get financing.
Great. Okay. So there are a lot of different variables because it's never a one size fits all. First of all, the practice can change the qualifications, and second of all, it can have different qualifications. And just whatever we talk about today, remember that there are rules or policies, but there are always exceptions to the rules or policies. So let's just kind of get that out there. So, all right, if I were giving advice to a potential buyer of a practice that was younger, there are a lot of things that we can run down. First, the obvious one is keep your credit clean. Just make sure you pay all your bills on time. And if there have been any previous issues, the best thing is to let your lender know up front, because you don't want to waste your time or their time and keep getting your credit pulled for miscellaneous reasons. Things that can affect your credit would be anything from medical collections, like the little small ones that you might avoid paying, to missing utility payments, to car payments, etc. And that's the obvious one that lenders look for.
And then, Rick, let me just stop you real quick. Yeah. If we can go back to the practice, you said some things about the practice could potentially dissuade a lender. What kind of things, just real quick?
Okay. One practice, a practice that, let's just say, spins off $200,000 in free cash flow every year, may be great for one family, but may be not enough for another family is what I meant to say. So let's just say you're a single guy or gal and you have you lease an apartment and you have minimal debt and some student loans. That would be great for you. But if you're the sole provider, you have 3 kids and a couple of car loans and a first and second mortgage, 200,000 may not cut it.
And so you're saying free cash flow is in just a typical production minus overhead or collections minus overhead?
In a very simplistic way, yes.
Or are you kind of taking into account doctor pay also?
Doctor pay also, yeah.
Gotcha. Okay,
Yeah.
so you're looking at not only the practice, what its production is, what the income would be for the doctor, but you're also looking at their personal expenses.
Yeah, right. Because what most dental lenders do is they first look at the practice itself, just to its stability, its trends, and several other factors. But then we want to see how that cash flow affects that family.
Got it.
So we essentially morph the two together. That's why a lot of people come to me and they say, "Hey, can you pre-approve me for a loan?" That's the most common question I get. And I said, well, I mean, I could talk, I could maybe look at your background and your balance sheet and your experience and tell you what size or range you might look for. But a pre-approval isn't always appropriate because maybe you're looking at something that isn't giving your family enough cash flow and room to breathe.
Got it. I was just wanting to get back to you talking about credit score. Any other factors from the buyer's perspective, like student debt or anything else that would influence their ability to get financed?
That's a great question. Most people are really concerned about the amount of student debt. Banks, for the most part, are not as worried about the amount. It's the payments that you select. My advice is get the lowest payments possible if you are attempting to buy a practice, because we look at monthly incoming funds versus monthly outgoing funds. I understand that most people want to pay off their student debt as soon as possible, but don't put yourself in a position where you choose a higher payment and now you're confined to that payment. And now the bank looks at it like your cash flow or debt to income or whatever wording you want to choose, depending on the institution, is constricted, even if you can afford that extra payment. So I always say when it comes to student loans, choose the longest amortization or payback period.
And how do you feel about the pay as you earn, where you pay 10% of your annualized AGI over the course of the next 12 months? Is that something you guys view favorably?
I haven't come across that too much. I'd have to run a couple different models on that. I would assume it's also not a one size fits all, but off the top of my head, it doesn't seem too bad. Seems pretty reasonable. But again, I'd probably get back to you on that after I run a couple different scenarios.
Sure. And then you talked about monthly expenses. I know that when we were talking privately a few months ago, you told me that you like to see that the doctor has enough savings to go cover some month's expenses. Kind of how many months are you guys looking for?
Great question. So the term that bankers use is liquidity, non-retirement assets. So that would include savings, checking, money market, certificates of deposits, stocks, bonds, cash value life insurance, anything that is accessible without being penalized because it wasn't taxed. So that's the definition. What I like to see is a minimum of 3 months of personal debt payments in cash. That would be pretty good. So let's just say you take your student loan of $3,000, car loan of $500, mortgage of $1,500. That's $5,000. That's $5,000. If you have $15,000, that's pretty reasonable. So I would also, then a couple of things that bankers like to add on there are credit card payments and maybe your monthly historical income taxes and some of it. They'll put in a buffer. So 3 months is a good starting point. 6 months is good. And anything above that's great.
And what if I included I use Mint. Are you familiar with Mint?
Yeah, absolutely.
So what if I included over 12 months, my family spent this much money in Mint and I have, 9 months or whatever saved up. Is that something that you guys would actually take into account?
Absolutely. Yes.
Okay.
Yeah. The logic is you want maybe 10 plus years ago, many banks really let customers live on the edge of having available cash. We don't want to ever put you in a position where you have nothing to fall back on if there's a slow period. If you're not able to pay yourself from your practice, how long can you survive on your nest egg? And that's the question I always make people ask themselves. So what I try to do as a lender is say, all right, if you were lending this money, what would you want to know? What would make you feel comfortable? And how many months would make you feel comfortable until the practice rebounded?
That makes a lot of sense. And Rick, in that calculation, do you guys include the practice note?
If we include the practice note, we will also include the practice cash.
Okay, that makes sense. And then when a doc is applying, how much does their associateship experience kind of play into their positioning in the financing world?
Okay, so ideally banks want 2 years, but there are some situations that warrant less than that. So a year, 9 months, I've done it before, maybe even less. Those situations would be like if the seller stays on and maybe even holds a note. So they're almost double holding your hand because they are helping the bank and the buyer feel secure that there will be less patient attrition. And then also they have skin in the game to make sure you succeed. Those are called, so that's where I talked about in the beginning, where there's a box or rules or policies, and you can break those by mitigating them. So bankers want to see several cycles of seeing patients, but we really don't know if maybe 2 years is too long. Maybe that's not enough. We're not perfect either as bankers, so it's really up to you sometimes to help us feel more comfortable if it's under 2 years.
I find it funny. You're almost describing my exact situation in terms of having the seller carry a portion of the note and also stay on with me. I was wondering, what portion of the note are you guys looking for?
So in my experience with all banks, when you're under $1 million for a practice loan, you will have less eyes looking at it. When you go over $1 million, for some reason that seventh digit adds a layer of scrutiny. And so to answer your question, what portion? I don't know if there's a magical dollar amount. I would say 10% and higher is good. And as the buyer, I mean, it's nice because that way they want their money. Now, not to get too technical, but lenders will never, the only downside to the seller is that lenders will want to make sure that the amortization of the seller note is not shorter than the bank note. So basically the terms have to match. And that seller cannot have rights to the business assets, only the bank can. So it's a sell, you have to sell the seller on it as well.
Got it. And I got a quick question for you. The way I have it structured is to be in line with the SBA guidelines, which I'm hoping to do a whole nother episode on. And I have it where I have 2 years of no payments on the loan to meet a SBA requirement, and then I have 3 years after that of interest only. So is that something that you guys would view favorably, in considering the fact that the cash flow I wouldn't even be paying that 30% of the practice price for at least 2 years?
I would consider that a miracle seller note. That is a very favorable deal to the bank and to the buyer.
And so then that million that you guys are talking about is the bank's portion of that note, not the total purchase price, correct?
Yeah, that's correct. Yes. Yeah.
Okay.
So, yeah. I was going to say, so that's just for the practice part. Sometimes there's real estate involved, which would be a whole nother conversation. But in general, with my experience, the client exposure on the commercial side with the bank, once it exceeds $1 million, gets a lot more eyes, whether it's just practice, just real estate, or a combination of the two.
And then, Rick, how much does a single banker have kind of leeway in the transaction, like you or another individual, versus is it kind of just the system?
It is definitely the banker for a lot of reasons. Now, let's just say you have it's just a golden deal. The buyer has a ton of cash, perfect credit, ton of income. I mean, it's just nothing that you could find adverse, and the practice is doing really, really well. And yes, I mean, in that case where it's a total no-brainer, anybody with a half a brain can get it done. But when there's transition and there's a lot of moving pieces, and there are situations where you are going to need to explain the background, write up a mini biography on the deal, explain that there are non-recurring expenses, run a cash flow, ask for different levels of working capital and other product lines. Your banker has to know, number one, what they're doing. They have to have experience in there. And this is something you'll never be able to know, but they better have a good reputation with their underwriters. What all these dental lending articles never talk about are what kind of internal reputation you have within the bank. You have to have clout to be able to move your clients properly and efficiently through underwriting. And sometimes it's hard to tell. I mean, you really have to interview who you're working with, because this is a kind of an art where you have to make sure that you can sell yourself to the client, being you, and that you can sell it to underwriting and that the underwriters trust you. Sometimes there would be a really big borderline situation, and because of the banker's reputation, it may go favorably for you as the banker, us as the banker, I should say, and then you as the client. So your banker is very, very important. Plus, there are times where, you may not like some of the part of the commitment letter that the banker provides or some of the terms, but you're willing to trade for some other, let's just say, bank products or whatever. I mean, part of banking, there is a little bit of negotiation. You want to make sure that that banker knows how to finesse that within their credit team and within their management. So the only way you're really going to find out that answer when interviewing the banker are talking to different people in the industry that have used them before, like dental accountants, people like Dr. Hunter Smith, like you noted, people on Dental Town, and whoever else referred you.
So really our only way of knowing that information is knowing who is the person that referred us, or having some sort of referral and it was a good experience with so-and-so, and so we're hoping that it's good experience with us. Yeah,
and another option that, what's interesting is I've only been asked this one time in my career, and it was 6 months ago, is a prospective client asked me for 5 references of clients similar to them. 5. Oh. And it was kind of a lot of work because I had to go track them down, get their written permission and, whatever. But I was like, yeah, no problem. And obviously they had to connect, but there's nothing wrong with asking that, because here's the other part nobody considers. Let's just say it's really easy to approve you for a deal. How do you know that your banker has the ability to properly and efficiently close your deal?
Yeah, that makes so much sense.
I mean, there's so much work that goes into it. How do you know that they know what they're doing on the back end? Because there's 2 steps to 3. There's the information gathering and analysis. Then it goes through underwriting, and they're going to have questions. And then that delivers what's called a conditional commitment, meaning the bank commits to you pending all these items that you have to provide. Well, I look at this, I simplify it to like a manufacturing line, and the product is sometimes a customer. How can I get them through without hiccups? And all that, in order to make that widget, there are a lot of different steps. And every time you try to refine it and perfect it, and every customer is different and every widget can have different issues with it. But at the end of the day, you got to trust that that person is going to take you to the finish line without problems.
Thank you, guy. That makes so much sense. And Rick, before we wrap up the topic, kind of the buyer's qualifications, I did want to ask you about the associateship perspective. I know you said you like 2 years. So for people looking for an associateship or current associates, is there like qualitative, some associateships are better than others, and you guys look at associate production or no?
Yes, we will look at, I like to ask for historical production, and then I make it proportional to what the seller was doing. So if you're doing $300,000 a year in production, but you're only working, say, 3 days a week, and the practice you're going to buy, that would be like $400,000, but hygiene's 30%. Then I could take, let's see, 400 divided by 0.7. Maybe a practice that's doing 575 or so would be adequate. That would be proportional, but there's always a buffer to go higher. It's not a perfect science, but something like that that's the way my mind works.
Okay, so then you would advise a student who's going to do an associateship to try to get an associateship where they can be as high producing as possible, not only for their personal income, but also for qualification?
Yeah, totally. I mean, you don't want to do something where you're annualizing at $500,000, you're buying a $3 million practice on your own. We'd be like, how are you going to be able to handle this?
Okay, so let's just say you have, I don't know, 10 people lined up that have 2 years of associateship experience and they're applying for loans. Kind of how many of them get accepted and how many of them don't?
The ones that we apply for, we have approximately 90% approval ratio.
Okay.
But within those 10, I may only, or I'll probably look at almost all of them. It's pretty rare that I find somebody that really doesn't qualify. I feel like they don't come up as often.
Okay, so you think pretty much if you have the experience, that's kind of the main hiccup to getting the loan then?
Yep, experience. And here's the other thing. Bankers aren't really the first people that buyers talk to, in my experience. I feel that buyers will find a CPA to analyze the practice, or they'll work with a broker, or they'll work with a dental attorney. I would say maybe 4 to 5 times. And those dental attorneys and brokers and CPAs may inquire about your backgrounds. And then they'll say, okay, you're not going to fit this bank, you're not going to fit that bank, you're going to fit this bank, you're going to fit that bank.
So they kind of screen them for you.
Totally. Yeah, if it goes through them. Because every institution has different policies. Some are better here, some are better there. It can go on forever about the positives and negatives, and we all compete with each other and we all sell around each other. We all know each other's boxes like the back of our hands. So I would say within every bank, by the time it gets to that bank, it's probably like a 90% approval ratio.
Okay.
Yeah. That's pretty high.
At speareducation.com, there's something called pathways. And what these are collections of courses that are grouped sequentially and by topic. That kind of sounds like my podcast. So this resonates with me. If you're interested in implants, they have an implant pathway. Takes you all the way from single posterior implants to anterior, more complex cases, and even full mouth fixed cases. So here's Dr. Frank Spear talking about those tricky anterior ones.
What I'd like to talk to you about in this segment is something that actually took me over a couple of decades of trial and error experience to really come to understand, and that is implant position in the maxillary anterior or mandibular anterior for ideal aesthetics, but also ideal soft tissue stability long term. And try and keep the head of the fixture to the palate so that if we're putting it into an existing ridge, we leave at least 1.5 millimeters thickness of bone on the facial aspect of the head of the implant. Now, I'm not going to talk specifically about immediate implants in this segment. I will in other segments. But when we do an immediate implant, we actually have to recognize we're going to lose some of the buccal plate following the extraction. And so we even want the implant slightly farther to the palate.
To give yourself clear pathways to success in implant placement and restoration, as well as many, many other areas, go to speareducation.com and get an extended guest pass trial when you mention the Shared Practices podcast. Use the promo code LOW200 for $200 off your annual membership when you're ready to pull the trigger.
And so when you get approved for a loan then, what's kind of your, again, let's just go with that very standard scenario, good credit, 2 years out of school, associateship solid. What's your max loan size for an acquisition that's cash flowing? Like how high will you guys go?
We'd like to be at about $1 million, but we've gone much higher depending on the scenario. So if there's maybe some real estate involved, I've done just sub $2 million. If there's, again, the seller staying on, if it's just a extraordinary case, we're happy going above. And in my experience, I've done a couple of them that are just under $2 million. We don't see them that large anymore, or at least maybe I don't. But yeah, up to.
And what if there's 2 doctors? So you have like partners. I'm married, so me and my wife potentially. Kind of how does that work then with the max?
The difficulty within all the banks, every single one of them, is their policies and their appetites can change. I feel that it should be proportional to the doctors. So if I was going to give you a loan for $999, why couldn't I give you and your wife a loan each for or $1 million? So every bank might kind of change every so often. You got to be really delicate once you get to that dollar amount because their appetites can change. They can swing all the time.
And is that kind of annually, or how often? Because I remember when we were talking, you said I have to kind of contact you a specific time before closing to get the current policies at the bank.
Oh, before applying? Yeah, right. I'd say every probably 6 months to a year. So in most banks, actually, especially all the large ones, there's underwriting guidelines, and then there's credit administration. And essentially, credit administration will usually be the ones that will audit the underwriters. They will audit the way that they underwrite each loan, meaning, okay, if you approved it, did you have enough justification? If you denied it, which ones to deny? What's the approval ratio look like? Then what's the loss run? Then are these clients bringing relationships to the bank? And so they're basically like the people that will protect the bank from getting in trouble with the government.
And Rick, when you say underwriter, can you take a step back and kind of define for our listeners the underwriting process and who does that and what role that plays in the loan?
Sure, absolutely. So us as bankers, we are essentially in a sense, the brokers between the customers and the underwriters. And what we do is we package up the request and we send it in for a review. The underwriters will pull the credit. The underwriters will analyze the buyer. They will analyze the seller. They will morph the financials together and look at multiple different areas and ratios to ensure that the bank doesn't have risk of being unpaid. What they will do, that's an underwrite. They will essentially underwrite the status or the future status of the loan or the current status of the loan. And so from there, they generate a list with what are called post underwriters or closers of what's needed to be able to fund the loan. Well, the credit administration team really are the ones that will keep the bank out of trouble because they want to make sure they continue to lend. And so in different banks, those administrators may say, you know what, you've been doing a really poor job and we have a lot of losses. And as a result, we're going to truncate this program or we're going to shut it down. Or they may say the opposite. Hey, you're doing a great job. Go ahead and expand your policies.
Okay.
And so there's no science to that. And I have worked at an institution where that was an issue before and they've corrected it and then, kind of ping pong back and forth. So this is just something that most bankers don't talk about or don't see or maybe have never seen or are unaware of. And my point is when you get above that $1 million mark, I can tell you from knowing all my competitors that is a very, very sensitive dollar amount. I don't know why that seventh digit is a big deal, but it is, no matter how many doctors, whether it's 1 or 5 that are in the practice. I don't necessarily agree with it, but it is what it is. So my advice is if you're looking for the real big practices, I would have a few lenders lined up.
That's definitely a good piece of advice there. And Rick, for the practice valuation, how does the bank look at it in terms of how do you guys value practices? Because we've kind of gone over that on the podcast already.
Yeah, so a lot of banks are at 70% of 3 years average revenues or less. At Bank of the West, we're at 75%. We take a look at the last 3 years of collections, average them. If it's 75% or less, keep moving. If it's 75%, if it's 75.01%, then we use a third-party valuation. That valuator has to have a CVA. You should be a certified valuation analyst or she. And it's just a designation where they do a calculation of value, not a full appraisal where they go through and they actually look at the equipment. They basically analyze it based on cash flow. It's like a 15-page report, nothing crazy. We do that for anything above 75% or anything above $1 million.
Is that a big deal being above 75%?
It depends on the market. I mean, some practices like I'm in Milwaukee, so one of my markets is Illinois and Chicago, even though we could pretty much do practices nationally. But I've done some that are 100% of revenues, but it just had such little overhead and profitability was so high, it was a justified sales price.
Yeah, that's kind of where I'm at because I offered 78% was the offer that I made. But I feel the practice has EBITDA margin of like 20% and has so many other things going its way, and then they're financing a good portion of the deal. So for me, I felt I had to offer that much to kind of secure all those other advantages. So if I'm doing that and I'm coming to you, how do you guys handle that? Do you send it to the third-party evaluator?
Well, not necessarily, because if the price is 78%, but the seller is carrying a note. The bank isn't financing all of it. And if it's sub $1 million in our policies, not every bank's policies, we would be just looking at what we're financing.
Okay, so you're looking at your financing percentage and what percent of the revenue that is.
That's correct.
Okay.
Yeah, so that would be, the bank would be very happy with that.
Well, hopefully.
So, yeah, right. Definitely.
So then what if the bank says, okay, we valued the practice and we feel it is not worth what the buyer is offering, and that maybe is the market price, you don't have an option at that point. So would the buyer be responsible for getting some sort of owner financing or some sort of third-party financing, or how would they handle that situation?
Right. So that conclusion would come from the third-party valuation, in which it's no different than an appraisal for a home or for a commercial real estate property, and the result is no different. The buyer would either would have to come up with the difference, and the bank would lower its loan amount. I have maybe seen one in my career. I'm just going to say that as my buffer, but I can't think of one situation where I had an issue. And because remember, the bank will look at its way of profitability on the practice and globally with the buyer's living expenses, taxes, debts, and all that stuff. If it cash flows to the bank, there's usually enough cash flow to support the price of the practice. So usually they appraise out. It's rare that they don't. The only time where I think it might not appraise out is, let's just say you as the buyer have another outside position or a spouse that makes a lot of money, and you don't really need a lot of cash flow from the business, but you're paying a premium for it. Then maybe that might be it might not work.
Okay. And then, Rick, you did say something about your kind of region that you work in. Do you finance loans nationally?
Yeah, we do. So our bank is in 23 states as of today, predominantly West Coast, Mountain Range, and most of the Midwest. So we're not in the South or on the East Coast. However, we are allowed a percentage of our portfolio to be what we call out of market. So if we look at something in, say, Florida, which we're not in, and it's a good deal and it's a big enough deal, we just take it to management. We say, hey, we want this exception to do this deal out of market.
Okay, so it's not a big deal then. So any of our listeners could contact you with a loan, and you should be able to handle it.
In theory, yeah. I mean, we want it to usually be probably at least probably $500,000 request, because they look at a percentage of customers, not percentage of the amount. So if we're going to do it, we want to make sure that there's enough of a return on the investment to justify going out of market.
Absolutely.
The logic is if it's out of market and something happens to the practice and we don't have a banker there locally to help the customer, our expenses are just so high to monitor the problem.
Yeah, definitely.
And that's the logic behind it.
Okay, Rick, I have a kind of hoping you could walk us through the lending process. So we're a typical, going to acquire a practice. If you could go through the timeline on how that works and the whole thing on your end, it'd be lovely.
Okay, great. So what I usually do, or what I always do, is I give a buyer and seller checklist. So, okay, buyer, I need these items. Sellers, I need these items. Once I get that, I write it up, call it 24 to 36 hours. It takes me to kind of organize it. And in most banks, there is a intranet system where you essentially build the application and send it in. The timing will usually depend on the following variables: what time of the year you're submitting it. So early and mid-May is busy because people are finishing their tax returns and packaging their information. This is a busy time for us. Around Labor Day, after the summer, so people are coming back from vacation, and then almost the entire fourth quarter because people want their deals done by the end of the year.
Okay, so this is when you apply. This is the time of year when you do the application?
Yeah, so those are the busy times, meaning the response times from bankers and their underwriters will be artificially delayed because there's so much volume. And larger banks like Bank of the West, Bank of America, Wells Fargo, PNC, the main dental lenders out there, will have a centralized underwriting process. So picture like a funnel. And as the deals come in, these underwriters that are in their queues will pick them up, analyze them, whatever. Well, the more that there are, the longer it'll take. They're not going to hire temp underwriters because they wouldn't know the systems and know the process. Well, I would say your average deal between, say, $100,000 and $1 million, you should expect an answer in 10 days is reasonable. Sometimes it's faster. Sometimes it's an extra day longer. Right now, we're running about 10 days just because of it's busy. Not busy, maybe 7 days. And then what will happen is when the banker packages it up and submits the loan, underwriting may or may not have questions. Usually they do. And the reason that they are going to have some questions is because they need to show, in case they get audited by their credit administrators, going back to that original point, that they were inquisitive, that they have asked questions, that they've dug deeper. So as a buyer, don't be offended if your banker asks questions. Now, the good bankers might know those answers, and you may never even see the questions. They may have already interviewed you well enough and know the deal well enough where they can either make it a conditional item of finalizing the financing, or they've answered it for you. They shield you. So from there, the underwriters they don't have their own approval authority. They'll say, okay, I support this deal. I'm sending it up to my boss. It's $750,000 request. They call it routing for approval. That's usually like a banker term. So, it's in the system. You look in the system where the loan's at. Dr. George's loan is with, was with Joe Smith, the underwriter. Joe Smith has routed it to his boss for sign off, and then you got to wait for the boss.
And how long before closing is that typically?
Well, from there, if the boss signs off, then you'll basically get a list of saying, okay, here are the items we need to close. So let's just say that timeline was 10 days to get formal loan commitment. From there, I'll say, okay, Dr. George, here's your commitment letter. Here are your terms to choose from. If you want to go ahead with us, sign this, give me a deposit. Let's get rocking and rolling. So now you've done the finance, the main piece. So the second part is we have to fulfill these items in order for me to be able to generate loan documents for you to sign in order to disperse money to your seller. These items can be super quick or can be delayed because the next set of items are non-tax return, non-financial. They're going to be stuff like, do you have your lease? Let's make sure that it's a long enough lease. Have you formed your corporation? Do you have your business insurance? Do you have your life insurance ready to go? Have you opened your bank accounts? Do you have your merchant processing converted? Like all these little ticky-tacky items.
So all those things need to be completed before the money is actually dispersed.
Absolutely, yes. And then, they're called conditional commit. It's a conditional commitment.
Going back to the deposit, kind of how much is that deposit?
It's really subjective. So let's just say that you get approved and you're not closing for 60 days, but you want to lock in your interest rate. A bank may take a good faith deposit as a percentage of the loan to guarantee the money for when you're ready. And every bank has a slightly different formula, but I usually think it's approximately like 0.5%. And that's, at least at our bank, something like that. We may take that money, but that's refunded at closing because we're going to lock in our rate with our treasury group and we want to make sure you don't bail.
So really, you guys don't approve a loan any more than 60 days before closing?
No, I mean, we can go up to 120 and we can even lock in rates longer. We just have to reapprove it every 90 or 120 days. So like we have a rate lock program for 6 months out. We're working on a rate lock program for a year out.
Oh, wow.
Which is crazy actually in my eyes, but we're doing the analysis on it. I'm not saying it'll work or not, but loan approvals usually in banks are good for 90 days. Every 90 days, you have to update two things: the updated financials and recheck your credit. Because in theory, a customer could file bankruptcy or the practice could nosedive after it's approved. So that's why every quarter or so, they'll just do a little check mark to make sure there haven't been any issues.
And then is the bank application filled out after the LOI and before the purchase agreement? Is that kind of where it is?
Ideally, we want to have some kind of structure when we do when we submit the application. So some kind of idea of what's being purchased, whether even if the LOI isn't signed by both parties. That's our minimum requirement. Some banks may say, we're not doing anything until you guys have a rock hard purchase agreement because we don't want to see any material changes. We want to do it one time and that's it. Some banks are pretty hard nosed about it. We're like, look, if we have a basic understanding of what the transaction is, even if both parties haven't formally agreed, that's okay with us.
Okay, so then we could fill out the application and then get the purchase agreement done and then submit that purchase agreement and then have that process continue.
Yeah, we're pretty laid back about it. I basically have a general conversation with the customer and say, do you think this is the deal that's going to happen as is? And if you think, yeah, I'm pretty confident, then let's proceed forward and get it approved and you'll be comfortable that your money's there.
Okay, so I have a closing date then. June 30th is kind of our tentative closing date. So how far in advance can I submit? Because I'm kind of waiting on lending is my big hang up. So once I have the lending done, then I can do the LOI and the purchase agreement. So how would I manage that process?
I mean, if your closing date is June 30th, you better be applying now.
No, June 30th, 2018, sorry.
Oh, okay. I would probably apply mid-March.
Okay, so then mid-March, you fill out the application.
Yeah, because if banks have an average approval time of 90 days, say it takes 2 weeks to get approved to be conservative, there's your 90 days.
Okay.
That would be an appropriate time. And and March is kind of an awkward time. Here's the other thing I would recommend. It is always ideal if you're in this like March or end of February to end of April time to have the prior year's tax returns done, if at all possible. It is so helpful because otherwise bankers are piecing together a lot of information. I mean, they really go by what the IRS shows.
So that's the seller's tax returns or the buyer's?
Both.
So then if I apply in January, can I avoid that?
Yeah, you can avoid it. But then remember that if the approvals only go through April, then they may ask for it when they update the approval.
Got it. Okay.
It's just, sometimes a lot of sellers file extensions every year because they have pension contributions that might take a long time. There's a whole slew of reasons. I'm not saying it is by any means a deal killer if they're not done. I'm just saying if you want to make your life easier, that is one thing to do.
Okay.
So what if you're not using surgical guides? How can a Form 2 help you in your practice? Dr. Michael Scherer has paired it with his intraoral scanner, and now it's basically replaced any impression taking and pouring up of models. He scans intraorally and then prints whatever he needs to print.
Instead of having to pull out the messy, gooey impression material, I pull out the intraoral scanner, and 5 minutes later, I've got intraoral scans that I'm sending to my printer, so that way when I walk in tomorrow morning, I've got models for me to work with or custom trays for me to work with. And I do it with everything. So my Form 2, I'm printing models for RPDs, for complete denture work, for frameworks for castings, single crowns, full cases, surgical guides, occlusal guards, you name it. And it's changing. It's changing almost every day. So somebody says, Mike, what are you going to be doing next week? And I said, I don't know, man, whatever I got to do.
If you want to see and hold for yourself the accuracy and the ability of this printer to replicate fine detail, go to formlabs.com/shared practices and request a free sample. You can choose from any of their resins, including their new dental model resin. I just did my second guided surgery, and it was a distal extension on 30 and 31. So I printed a bone rest on the distal of my guide, and I printed the mandible so that I could verify that it was seating. It looked awesome in the dental resin because it's this nice beige color that it's familiar to us because it looks like a stone model. And to be honest, the gray totally works, but the beige looks better. The dental model resin looks better. So check it out at formlabs.com/shared practices.
Rick, I did want to talk to you about, when we were speaking, we talked about the business plan, and I was hoping that you could kind of talk to our listeners about the business plan, what you look for in the business plan, any advice on writing it.
I mainly use business plans on startups.
Oh, so you don't even look at them for an acquisition?
Not really. I mean, we have in our application, there's a half a page section of things that you would change. It's a good want to know, but not necessarily a need to know. What I really look at what I always say is I'm going to change the marketing. I'm going to put up a sign. I'm going to have a Facebook page, whatever. we're not looking on a projection basis on an acquisition. History is usually the best indicator of the future for banking, so we're going to apply those numbers, and if they work, great. If they don't, there's a section in the application where I discuss non-recurring expenses. That is the best part about the business plan. So a lot of sellers will have like a spouse on staff that's the quote unquote marketing coordinator, and she makes 40 grand a year just to have some write-offs. Or a nephew or a niece on staff that's like the computer person that isn't really there. So when you take over, those expenses aren't going to be recurring. Or they may have a country club membership or have been writing off their car. I mean, I saw one time I'm not going to say where, but I was trying to understand why this practice was underperforming. And this guy in the previous year had written off his daughter's wedding, and it was like $75,000.
Oh my goodness.
It was crazy. Yeah. And so, I'm not the IRS. I'm not there to judge whether the expenses were legitimate or not, but we got the appropriate documentation. And that business plan basically alluded to a understanding of the seller's financials and what is really BS that the buyer's not going to incur. Now, I'm not talking about little $100 things here and there. I'm talking about things that are a couple thousand a year or more.
Wow.
And that's what I really care about, because that's what impacts cash flow. Dental lending there's really no collateral. I mean, the field of dentistry has evolved to a point of I hate to say it, one of the most privileged sectors within small business in any bank. I mean, you guys can get 100% financing for your business. If you're a manufacturer and there's actual raw material and major account receivables, like you can't buy a manufacturing plant for 100% in small business. You can't buy anything industrial or retail, and even in some banks, a lot of other medical sub industries, whatever. But dentists have a really cool program, and there's no collateral, so except for the patient records. So cash flow is king. And us knowing that we do not ever have our funds at risk is the biggest thing for us. So your business plan should help tell us that story. That's the most important for us. You want to open more hours? Cool. You want to put up a different website? Great. We kind of expect you to do that.
Is that kind of universal among all bankers when it comes to acquisitions? Because that's kind of honestly the first time I'm hearing that the business plan isn't that important for an acquisition.
I would hope so. I would love to know if you have a business plan, what bank is really putting weight on that and why? Because if you're going to change, like you're going to get rid of Judy in the front desk and replace her with somebody else, and you're going to change hours to this, and you might have a dental consultant come in and tell you how to bill for more. Great. I mean, that's all future stuff, and it's nice to know, but there's really not much weight placed on that. It's for you.
And what if you're one of the exceptions and you're not within that box? Would that business plan then be more important than if you're kind of within the box of standard lending?
I think it would always helps. There's nothing wrong with it. We love to see it. We'll read it. We'll place a little bit of merit on it. But if that box and you're outside of it, I would hope that you are alluding to things that are affecting the profitability that are going to change, and that you not just explain them, but you justify and verify. Like the seller has been spending $24,000 a year on yellow pages. I don't even know where you find the yellow pages anymore.
And then Rick, you keep noting the profitability of the office. So are there metrics that you guys go by in terms of like a ratio of debt to income? Like how much your payments are going to be versus your income? What percentages, kind of how do you guys assess that?
Yeah, so every bank does it a little bit different, but to simplify it, we use a global calculation that encompasses the individual. So that's why it's not a one size fits all. So I'm going to be pulling in your student loans, your mortgage, blah, 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 blah. And what I really look for is 1.25 to 1. So that basically means for every dollar you spend, you as a family and a business are making $1.25. That's roughly industry average in dental. That gives a buffer to be able to fail, and a nice buffer.
And so that's including the practice note, I'm assuming?
Yeah.
Okay, so that's after you have all your income, your practice note, all your personal expenses, then we should have 1.25
Yeah,
on every
and
dollar.
mind you, we don't look at expenses like, hey, you're throwing in cable bills and stuff like that. We assign, every bank's a little bit different with this. So these are just our policies. So for us, it's 8,000 a person for families. So say you're a family of 4, we would just assign a living expense amount of 32 grand, 8,000 times 4. Family of 5, 40,000. And then we use your actual taxes and then your annualized P&I payments on your debt.
Okay. And then it's
So,
principal and interest.
Yeah. Yep, exactly.
And for the actual loan terms, when you're looking at from the seller's perspective or from the buyer's perspective, when you're looking at it, is there anything we need to pay attention to other than the interest rate and the amortization schedule?
Yeah, lots. First of all, prepayment. What's the prepayment penalty if you want to leave early? So some banks have very complicated calculations. Some banks have simplistic calculations. Some banks have no penalty. The ones that have no penalty may be tiny bit higher, but you have freedom to leave whenever you want. Because what if all of a sudden you need to move across the country, or you sell the practice, or you want to do more remodeling, that bank isn't able to help you. You want to be able to come and go as you please. So prepayment's one thing. Second of all, next thing is what ongoing reporting requirements will you have? Banks have the right at any point in time to require your updated financials. It could be 6 months in the loan. You need to make sure, the more simplistic, the better. Some will require it no matter what. If you're over $1 million, you're probably submitting them annually, and some banks quarterly. If you're under $1 million, it's usually 0. The next thing is working capital. Is the bank giving you working capital in addition to the loan in the form of a loan, or is it a line of credit?
What would you prefer?
If I were a buyer, I'd want to have a line of credit, because once you blow through the cash, it's done. But a line of credit, you have access to capital at any time, ongoing. Plus, what if you don't use all of it? Then you're still paying P&I on it.
That makes sense.
You see what you should see if you can get that. Is the bank offering you a credit card? Are they offering you ability to cover expenses ongoing? One of the things that's really odd that people have a hard time with is, even though you're acquiring existing business, a credit card company will look at you as a new business because it hasn't been your business. Even a home mortgage lender will. So we make sure we give our businesses credit cards. We give up to like $75,000 limits.
Oh, wow.
Yeah. Sometimes higher, sometimes lower.
Any other terms?
You should be looking at what banking requirements are there. Most banks are probably going to want you or make you bank with them. It's very common, because they're like, listen, if we're going to give you this $700,000 goodwill loan, we want to be your bank. We want to process your deposit. You know what I mean? Like, there's really no hard assets outside of some equipment. They're saying, if we're going to finance this practice at 100%, and it's predominantly goodwill with no true real estate collateral, we want to be your bank. And that's very standard. All the major players will do that. Occasionally they'll waive it, like if they're not in the market, or the buyer has his wife works for a bank, or husband works for the bank, or there's a bank in the parking lot. Like, there are logical reasons where we understand we can't earn your entire business banking relationship. But that is a very common thing that bankers will put in a commitment letter.
And then I have just a few kind of random questions to finish us out here.
Sure.
In terms of multiple locations, then, let's just say you have one practice and you're looking to get second practice. How does that affect lending versus the single office?
Great question. Acquiring a second one is really no different. You're just adding another location. I have clients with 3, 4, 5 offices. Usually there's at least 2 doctors there to cover it. But at some point, the practice banks, and it's different at every bank, will say, all right, we want to be lending to the operator that's not an investor. The doctor that's not an investor. We don't want to be lending to practices where the doctor is not really there and there's just an associate. At that point, you outgrow the bank, and you're probably going into private equity if you're going to continue growing and buying practices, because the banks will cap you out at some point.
So you guys do want not absentee ownership, then you will not
That's
loan
correct.
for absentee ownership.
Yeah, because it's practice lending is very liberal. We're giving 10-year terms on acquisitions at 100% financing plus working capital, essentially cash out. And at some point, And we're lending to that. It's really the name behind the practice and the individual's personal balance sheet, the individual's credit, because they're all personal guaranteed loans. So at some point, we're going to say, all right, this individual isn't even involved anymore.
Okay, but at that point would be kind of down the road, not a second or third. That
That's
would
right.
be like an eighth
Correct.
and ninth.
That's right.
Okay.
And there's no magic number. Some banks will look at it as to the number of practices, saying like, okay, he can't be at all these places at once, no matter what he says on his schedule. Or some banks may say the total debt.
That makes sense. And then Rick, what is kind of what you guys are offering now? You said 10-year term. What's kind of an interest rate? Is that fixed or variable?
It's fixed. Yeah. So I would say if you're looking for a good rate that's in kind of the median, if you're in that like mid fours with no prepayment penalty, $500, and we usually like to have automatic payment if you're within our markets. That's pretty standard. Some banks may be a little bit lower, but may have a very harsh penalty. Some banks may be higher, but money's very inexpensive. And if you have anything sub 5% or in that low fours or high threes, whatever, that's what I call your gross interest rate. After your write off of your interest rate, all those rates within a quarter, half point of each other are going to blend in to be the same net effect.
That makes sense.
So choose your bank wisely, choose your terms wisely, choose your banker wisely, because the other thing I notice is that customers will come back for equipment, different remodels, and for second and third loans, and you want to make sure that banker isn't going to kind of ditch your relationship after they're done.
Absolutely. And Rick, I had another question about partnerships with you. We had an individual on who bought into an office, and I was kind of wondering to myself, if I was as an associate in a practice and I was buying in 50%, and the seller had debt on the office, they hadn't, paid out their practice loan yet. How does selling equity in a practice affect the loan versus selling the whole practice? Kind of how does that work?
That's a really good question. We would first want to know how that loan for that other so you're basically saying that the other 50% order that's remaining has a loan for his buy-in or her buy-in, right?
Yeah, let's just say they bought the office, then they grew it, now they need a partner, so they're bringing in somebody for the other 50%, so then they'll sell it. Do they have to pay back their loan with that proceeds of the partnership, or can they keep that and just keep making their payments?
Very good question. It's super situational. So there are so one of the factors we'll look at the total debt to revenues, kind of going back to our original question. But before that, we're going to look and see who has the lien filing. So if you want to do your buy-in, but then the other guy has a loan at XYZ Bank and it has a lien, I can't do your loan unless I take over his loan. And I can't take over his loan unless I show him a benefit to moving his loan to me. And so the path of least resistance is usually you going to his bank. But what if his bank can't do your deal? Which is why it's important to have no prepayment penalty on practice debts or little prepayment penalty on practice debts. There's really odd situations that come up. So then you want to have flexibility. So now I would say you're like, all right, I got a practice that's doing $1 million, and this guy's got $400,000 on his practice note, and I'm buying it for $400,000. Well, my debt to revenue should be probably $750, so he should take of my 400 and pay down his by 50,000, and now we got to figure out which bank to go to.
Okay, so then you would look at it as you're taking a new loan for the entire practice of the combined debt of the seller and the new equity portion of the buyer, and then that's how you're assessing the situation.
You nailed it. Exactly.
Oh, that makes a lot of sense. I never realized that.
Yep. And then there's another variable in a kind of similar but different situation. Let's just say you are buying into a practice with a doctor that has zero debt on the practice.
Okay.
This is one thing that I always tell the buy-ins are usually the trickiest ones, because you will be the borrower as an individual. The guarantor, so the cosigner, would be the business or the practice. And then we would have a lien on the practice. So the person you're buying into with has to understand that those assets will now be encumbered by your loan. The person staying on won't personally guarantee, but the business will. And some people that you're buying into have an issue with this. So when you're doing buy-ins, get your banker involved with that partner staying on immediately.
Because the seller won't want their portion of the practice to be on a lien with,
Yeah.
That makes a lot of sense.
Yeah, it does. And 50% of the sellers don't care. And, of the other 50%, 25% have an issue with it. And the other 25%, you have to hold their hand through and explain why it's the logic behind it. But what you don't want to do is all of a sudden get to the very end and all of a sudden, and the seller's like, I'm not signing this. You can pound sand. And then the deal falls apart and everybody's wasted a lot of money and time. So on the situations where you're buying in and there's no debt and the seller's staying on, or you're replacing somebody's ownership, like say there's 3 partners at a third each and you're buying 1/3, you have to get your banker involved with those people staying on right away, the banker and maybe even an attorney.
So if that's your plan then, to buy a practice and to grow it and then to bring in a partner, it would almost be best to talk about that ahead of time with your banker to make sure that bank is familiar with that type of transaction.
Yes.
Okay. And then Rick, before we kind of close off, is there any advice that you could give to our listeners? They're all mainly pre-owners looking to acquire a practice or start a practice.
The best thing you can do is, it's not really, really hard to do, but pay down all your debt and build as much cash. It's like the obvious answer. I would not be making large principal payments on my student loans. I would keep the cash, because if you have a $500,000 student loan and you apply $50,000 towards it, doesn't really do that much. It reduces your total debt, maybe your long-term interest paid, but now your cash is gone and your monthly cash flow looks the same. Doesn't do anything. So that's one mistake some people make. Don't worry if you buy a home, we recognize that you just use some money into it. So don't think that you should avoid buying a home if it's good for your family. We will take into consideration that you spent that cash. Check your credit every so often. Make sure there's no little medical collections. Credit card debt is taboo, and get as much experience as you can. If you have the experience and you have a reasonable balance sheet, you've saved some money and you don't have anything crazy, you pay your bills on time, you'll be fine. Don't worry about it. And the second you have a deal lined up, try and get your banker involved. See if they see any holes in it. See if they look at the trend lines of the practice. Ask about the non-recurring expenses. Get a letter of intent going. Try to be as organized as you possibly can.
Awesome. And then Rick, I have one more question for you. Something came up when you were explaining that. So I've always thought that it was you buy the practice, then you buy the home. I always thought it was practice purchase first, and then you buy the home. Is that kind of what you're seeing, or are you saying that you could buy a home first?
You can do it anyway. It's over the last 4 years, the home mortgage regulations, and I only know enough about this to be dangerous. I'm not perfect, but they've gotten a lot harder if you are a new business owner. This has nothing to do with dental. This is any business, meaning a home mortgage lender may not take into consideration the seller's financials and what they did, because they're not yours, unlike a dental lender.
Okay.
So all of a sudden you buy his practice and you made $500,000 in year one, and you're gonna go buy a home. And you're like, what do you mean? Who cares if I don't have 2 years of income? They're gonna have a problem with that. So there's been an issue with that. However, there are a few, like I haven't seen too many lately, but I might have to check around to get an answer on this, that are specialists with doctors. That there are a few banks that have recognized this, and they change all the time, but there are some. So you have to kind of ask around and maybe pose a question on Dental Town or something like that. See, somebody will pop their head up or raise their hand and say that they've had experience with it. So there are some specialists within there. I would just say whenever you need the home, buy it.
Okay. I didn't realize that it was actually that way. I had always thought that it was the home loan sometimes held up the practice loan, but I guess you're saying that you guys go based off the financials, and so that makes a lot of sense.
Yeah, if somebody has lower liquidity because they just put down 20% on a home and they can verify that, I understand. That is a mitigating factor to lower cash. You bought home, you put something into a hard permanent asset that is positive for your life. That is the way I have always looked at it. If you spent 20 grand and you bought a used BMW, that would not be a great investment when you're applying for a commercial loan.
That makes a lot of sense, Rick. And again, I really appreciate having you on. I took up my hour that you promised me, so I appreciate all the information, and I think it's a great resource for our listeners.
My pleasure. Anytime.
Okay, welcome back. Rick was awesome. I really enjoyed that. I think he showed, and actually it was your reaction to some of the things that he said that showed me the difference between what bankers care about. So what was it that he said that was surprising to you?
There's two things that Rick talks about, and we'll get to one of them later about, your personal savings. But the one that really struck me as odd was the business plan. Every banker I've talked to talks about the importance of the business plan. And even Rick, I was talking to him before, he's giving me advice on the business plan. And then, to kind of hear him say that if for an acquisition, it's not really that important. I just really was surprised by that.
Well, and he made the point of, for startups, it is a big deal. For acquisitions, it's like the business plan is kind of already there. It's like they just don't want you to screw it up. Like your ability to just step in and take this machine and continue it on at its current rate, because that's what they're valuing, is how the business is currently doing. As long as you don't screw it up in their mind, it's going to pay for itself.
I'm with you. And I think that the current rate is the emphasis for them. And I think for us as buyers, we focus so much on what we can do to improve the opportunity. So for any of our listeners who heard that and were like, oh, great, I don't have to make a business plan, I would highly encourage you to make a business plan for you and for your plans to kind of organize your thoughts about the opportunity. And still, maybe not, you can include it in the application, but apparently it doesn't make a huge difference.
To Rick. And I think that's the important part. Yeah, because you might get a banker who cares a lot about that. And the underwriters want to see that, and they want it all documented, and it's going to increase their trust in you. So I think are we going to do a whole episode on business plans in the future?
I'd like to. Yeah, that's definitely something I'd like to talk about. But you did kind of bring up something with the underwriters. And I know you were really thrown back by the banker and the underwriters relationship.
Yeah. The interesting thing to me that I love to hear him say was that there's a difference in internal trust between underwriters and certain bankers. Like a banker can have a good reputation or a bad reputation to the underwriters. Like it's like some of your classmates you would trust to do a crown, and maybe some of them you might not. And they have that internal knowledge. So if you have a banker who is very, very competent and the underwriters trust them, then your loan might get approved a little bit faster, or they might need a little bit less documentation, or I don't know. It just was interesting to hear that really does play a difference. And that the underwriters are trying to cover themselves with the documentation. So what they're supposed to come back to the banker and say, well, what about this? What about this? And the best bankers know what the underwriter is going to need, and often can answer those questions or has those things already for the underwriter. So it doesn't have to come all the way back to you and you send back some other email, some other thing. And so that to me also showed the value of specific bankers within a bank. You can have a great experience with one bank. You can have an awful experience with one bank. And I've seen that from a Facebook post recently on Dental Hacks. I was asking about a certain bank because we had a question about it. And some people had awesome experiences and got a good rate, and other people had awful experiences. And it came down to, it was probably the banker they were working with.
And about the banker you're working with, I asked Rick in the interview, I'm like, well, how much is our approval based on you specifically or the process? And I was surprised at how much of it is based on the banker's desire to finance you.
Yeah, that's nuts. And that internal trust is what gets loans approved, which is kind of crazy. And the other thing that he said that he kind of cracked the lid a little bit for us was shifts in approvals and documentations over time, that policies within a bank change on an annual basis. And so maybe they want more dental loans this year, or maybe they're new to dental lending, or they have too many, and so they want less. And so what might have been approved before might not get approved later, or what might need certain documentation might change. So I just thought that was interesting as well, that it's not going to be the same year to year even.
And then going back to how our listeners could use that information, if you know what year you're going to be buying a practice. Like for me, I tried calling Rick in 2017 when I'm purchasing in 2018. So he kind of told me check back in at the beginning of 2018. And so I think if you know what bank you're going to go with, or you have an idea and what year you're going to buy, then contact them and start figuring out these things. Because as we said it before, there's a difference between banks. So it's important to know what your bank that you're going to work with is looking for.
Absolutely. Was Rick the one who talked about owning a home versus renting and that not being a big deal, or was that David Alvey? I can't remember.
Actually, I forgot to ask David Alvey.
Okay.
So I shot him an email after we shot the episode.
Okay.
And so I'm going to share his response in that episode. But in this one, I think Rick said that it's kind of either works.
Yeah.
I don't think there's he doesn't really seem to care.
That was also interesting to me because I had heard specifically that like bankers care about a home loan because it's a commitment that you can't get rid of, whereas a lease can change and you can downgrade or upgrade a lease. You can get out of that. It's more liquid or more flexible. And so I had been told, like, don't buy your house before you buy your practice. And I've even said that on the podcast. And that was one of the factors that I thought was that it's harder to get lending if you have a big loan and this big commitment and this personal financial obligation. But he was like, no, not a big deal. Like, I understand if you threw a bunch of liquidity at buying a house and now you've got that commitment, like that's just part of life. So once again, difference
Him and
between
David
bankers.
were both like that.
Really? Okay.
Yeah. David was also saying the same kind of thing. And the thing that Rick was unique in is he talked about the importance of your personal savings, and it makes sense. It makes a lot of sense, but he's the only guy I've heard it from is talking about the importance of your personal savings balance to be able to cover yourself so you don't need money from the practice for a certain amount of months.
Well, and so that's definitely a throwback to Reese Harper's episode. So he talked about 6 months of personal spending, not so that it's not a down payment. It's liquidity so that when there's bumps in this whole process, you can float through those harder times and maybe make the hires that you need to make and make the decision you need to make, having that personal liquidity set aside, and how important that is going into this whole process. So definitely a important factor there in preparing for ownership.
Hearing that twice really kind of reinforces my wife and I. We decided to max out our student loans with the purpose of living off of as, a reasonable budget, not overspending, but then having a lot of personal liquidity when we graduate so we have opportunities in ownership. And so I'm definitely happy to hear that it wasn't a bad decision for us to do that because it helps us get into ownership faster.
Yeah. And when people talk about maxing student loans, and sorry, this is a little side tangent, but we're on banking, we're on loans, so this all kind of fits. But there was some people in dental school who had this sentiment of, I'm going to max my student loans because I'm going to ride them out to the end and let them get forgiven under pay as you earn or whatever. And I really felt uneasy about that. But what I do like is what you just said, that if you do have more student loans, then you have extra student loans. Rather than paying those immediately back towards your student loans, keeping them as liquidity, that buffer, that liquidity is huge. And so I've been asked this before, what do I do with this extra money that I have from dental school loans? And do exactly what you said, George, is keep it liquid. Don't invest it in something that's going to penalize you if you need to access that. So up to 6 months, it can be a lot of money to just have sitting there. And you're thinking about compound interest, you're thinking about your student loans, and you want to throw the money at all these different things. Having that liquidity in this crucial period of finding jobs, saving up for a practice, buying a practice is the best thing that you can do, hands down. So don't feel bad about that at all. And you got the 2 thumbs up all around.
Means a lot to me, Richard. Thanks.
Yeah, you're welcome. Thank you guys for sticking around. This was an awesome episode. If you really liked it, go on iTunes, leave us a review, reach out to us if you have any questions, and we will talk to you next time on the Shared Practices podcast. Take care.